Have you ever noticed something strange about the whole house versus stocks debate in early retirement? People almost always start with the wrong question. It sounds logical, responsible even. But it's also the question that quietly leads so many people in the wrong direction. One quick thing before we dive in. If you're not subscribed, hit that button now. I think you'll want to stick around for what comes next. The real question isn't whether a house is better than stocks. It's whether your money and your home together can support the life you actually want to live. Here's the thing. A lot of people talk about early retirement like it's a contest between two objects. A house on one side, stocks on the other, as if you're supposed to pick a winner and then build your whole future around it. But that's a quiet lie, because when you retire early, you are not trying to win an argument. You are trying to build a life that still feels steady when the paycheck stops. Think about a house for a second. Not the paint color, not the furniture, not the curb appeal, the foundation. You don't wake up every morning thinking about it. You don't show it off to guests. But if that foundation is strong, the whole house feels safe. If it isn't, every little crack starts to matter. Your income floor works the same way. Strong, underground, invisible, but holding everything up. Your savings are more like the furniture. Nice to have. Comfortable. Important, yes. But they sit on top of something else. Most people spend years decorating the furniture while barely asking whether the foundation is solid. That's why most people walk into retirement focused on account balances. They look at their 401k, their IRA, their savings, and they ask, is this enough? And if the number doesn't feel big enough, they feel behind, even if they have something incredibly valuable sitting right in front of them. The goal of retirement is not wealth, it's income. Let that sink in. Because if you retire early, this matters even more. You are stretching your plan over more years, more birthdays, more grocery bills, more surprise expenses, more time for inflation to quietly chip away at what used to feel comfortable. So if you start with the wrong question quietly erodes your confidence for years. I want you to picture your retirement in two piles, not one giant scary number. Two piles. Pile 1 is income that shows up no matter what. That could be Social Security later on. A pension, rental income, maybe part-time work you actually enjoy. Money that continues whether the market is calm or having a breakdown. Pile 2 is your savings, your investments, your stock accounts. The money that can grow, but can also shake your nerves when it drops. Now here's the critical mistake most people make. They focus almost entirely on Pile 2, while barely acknowledging Pile 1. And yet Pile 1 is often doing far more heavy lifting than people realize. Now bring your house into that picture. A paid-off house doesn't send you a monthly check. That's true, but it can do something almost as powerful. It can lower the amount of money you need every single month just to stay afloat. And when you need less, your investments don't have to work as hard. That matters a lot. Here's a question. If you had to choose between more money or more certainty, which would it be? Keep that in your head as we go, because certainty is what people are really chasing. Let's meet two people. The first one, let's call him Frank. Frank is 67. He spent over 3 decades working a steady, dependable job. Nothing flashy, no big windfalls, just consistency. If you saw him walking down the street, you wouldn't think, there goes someone financially secure. You might actually think the opposite. Frank lives in a modest home. He drives an older car. And if you looked strictly at his savings, you'd probably panic for him, because Frank has around $140,000 saved. By the standards you've been taught, Frank is behind. But here's what you don't see when you only look at that number. Frank has a monthly pension. He has Social Security income. His home is fully paid off. Every single month, without touching his savings, money shows up, consistently, predictably. Frank is not struggling. Frank is not stressed. Frank is living a life that works. Now let's meet Gary. Gary did everything right, at least according to the rules he was given. He saved aggressively. He invested diligently. He followed the benchmarks. And today, Gary has $800,000 saved. On paper, Gary is a success story, but Gary doesn't feel like one. Gary still has a mortgage. Gary doesn't have a pension. Gary relies heavily on his investment account to fund his life. Every market fluctuation feels personal. Gary has more money than Frank, but less peace. It's not about who has more saved. It's about who has more certainty. And that right there is the truth most people miss in the house versus stocks debate. A house and stocks do different jobs. If you ask them to do the same job, you're going to confuse yourself. Think of a house like a heavy winter coat. It doesn't move you forward. It doesn't make you richer every day in a visible way. But when the weather turns, you are very glad you have it. A paid-off house is protection. It lowers the wind hitting your budget every month. Stocks are more like a garden. If you give them time, they can grow. They can feed your future, but they can also have bad seasons. Too much rain, not enough rain. Storms at the wrong time. Both matter. But they are not interchangeable. That's why the real answer is not house or stocks. The real answer is role and timing. If you're still working and you're decades away from retirement, stocks usually do the heavy lifting for growth. That's the garden stage. You need things that can compound, which is just a simple way of saying they can keep growing on top of previous growth. But if you're moving toward early retirement, the conversation changes. Not because growth stops mattering, because stability starts mattering more. Imagine walking onto a car lot. Every vehicle has a sticker price, bold, official, intimidating. It looks final, non-negotiable. But if you've ever bought a car, you already know the truth. Nobody pays the sticker. There are hidden discounts, dealer incentives, timing advantages, negotiation room. The real price is almost always lower. But the sticker exists to anchor your expectations, to make you feel like anything below it is a win, even if you're still overpaying. Now take that exact same system and apply it to retirement. That giant number people throw around as the amount you need to retire early, that's your sticker price. And here's the thing. Most people are being told they are behind when they're not. Those giant numbers usually assume you're funding everything from investments alone. They often quietly ignore a paid-off house. They ignore future Social Security. They ignore pensions. They ignore lower spending. They ignore the fact that some people do not need a luxury lifestyle to feel free. They take your life, flatten it into a formula, and then hand it back to you as if it's truth. It isn't truth. It's a starting point at best. Now listen, if you are dreaming about early retirement, your house can be one of the most powerful tools in your plan, but only if you understand what it is and what it is not. It is shelter, it is stability, it is expense control. It is sometimes the invisible asset that keeps your withdrawals low enough for your portfolio to survive rough markets. But it is not automatically income. It does not buy groceries just because the Zestimate went up. You cannot eat home equity. You cannot pay the electric bill with a guest bedroom unless you have a real plan to turn that home into cash flow or reduce costs through downsizing. That's where people get tripped up. They say, my house is worth a lot, so I'm fine. Maybe, maybe not. If the house is paid off and your taxes, insurance, upkeep, and repairs are manageable, that home may be doing tremendous work for you. But if it's expensive to maintain, too large for your life, or carrying debt into retirement, it may be doing the opposite. What do you think? Are most people actually behind on retirement, or are they just measuring it wrong? Now let's bring stocks back into the picture, because stocks matter too, a lot. Think of your stock portfolio like a bridge over a river. If the bridge is long enough and strong enough, it gets you from your working years to your later guaranteed income years. That is especially true in early retirement, because if you retire before Social Security starts, or before a pension kicks in, your investments may need to carry you for a while. That bridge has to hold. And here's where it gets real. The biggest danger is not just whether stocks go up or down, it's when they go up or down. That's what people mean when they talk about sequence of returns risk. Sounds technical. It's not. Imagine you're climbing a hill with a backpack full of food. If you slip near the top, it hurts. If you slip right at the beginning and spill half your food, the rest of the trip gets a whole lot harder. A bad market early in retirement can do that to you. If you're withdrawing from investments while they're falling, the damage can be much worse than the same drop later. This is exactly why a paid-off house can matter so much. Not because it replaces stocks, because it reduces pressure on stocks. Lower monthly needs mean fewer forced withdrawals. Fewer forced withdrawals mean more time for your portfolio to recover. That's not exciting, but it's powerful. Think about this. If guaranteed income was the only thing that mattered, would you feel better or worse about where you stand? And before you answer too fast, remember this. Your future guaranteed income may be bigger than you think. Think of Social Security like a faucet. Behind that faucet is a pipe, one you've been filling your entire working life. Every paycheck, every tax contribution, it all builds pressure in that pipe. Now here's how it works. The longer you wait to turn the faucet on, the stronger the pressure becomes. Wait until 70, the flow is powerful. Turn it on at 62, the flow is lighter. But here's the part most people don't think about. That faucet belongs to you. You paid into it. And if you wait too long to turn it on, some of that water never reaches you. It just stays in the pipe, unused, gone. The question isn't what's the best age. It's what's the best decision for your life right now. If you retire early, that question gets even more personal. Maybe you leave work at 58 or 60, and now you have a gap before Social Security starts. That gap has to be covered somehow. Stocks may do that job, cash may do that job, part-time work may do that job, a smaller house may do that job by lowering your costs. But you need to know what the bridge looks like before you step onto it. And if you have a pension, now we need to talk about that too, because pensions are often treated like background noise when they should be treated like gold. Think of a pension like an old fruit tree in your backyard. It may not look flashy. Nobody on television gets excited about it. But season after season, invisibly, steadily, it produces. If someone had to buy that same income with a pile of cash, the price would be huge. But because a pension arrives as a monthly payment instead of a big account balance, people underestimate it all the time. You may already have what people with millions are searching for. Let me ask you, have you ever calculated what your pension is actually worth in real dollars? Most people never do. And that matters because if you are comparing a paid-off house to a stock portfolio while ignoring a pension or future Social Security, you're comparing the wrong things. You're leaving out half the picture. Now let's talk about inflation, because inflation is the silent eroder in every retirement plan. Think about a pair of shoes you wear every day. The first week, they feel solid, supportive, reliable. But over time, the soles wear down. Not all at once. Quietly. You don't notice it until one day your feet hurt and the cushion is gone. Inflation works like that. It quietly chips away at what your money can buy. A house can help here. If your mortgage is fixed, or better yet gone, you have some protection against rising housing costs. That's real. That matters. But don't romanticize it too much. Property taxes can rise. Insurance can rise. Repairs can come out of nowhere. Roofs do not care that you're retired. Air conditioners do not care that the market is down. Houses fight inflation in some ways, but they are not cost-free. Stocks, on the other hand, can outgrow inflation over long periods. That's one of their biggest strengths. But the price of that strength is volatility, which is just a polite word for emotional whiplash. Some years feel easy. Some years feel like your stomach is in a washing machine. It's not pessimism, it's realism. And in this case, realism isn't negative. It's empowering. And yes, Social Security has cost of living increases, what people call COLA, which is just a built-in adjustment meant to help benefits keep up with rising prices. That's helpful. But helpful is not the same as perfect. Those increases may not match your personal cost increases, especially if healthcare, insurance, and home-related costs start slowly raising the pressure on your budget. And if you have a pension, it may adjust less than you hope or not at all. That's why early retirement planning cannot be built on one shiny idea. Not a house, not stocks, not a pension, not Social Security. You need the whole picture. I want to ask you something personal. Have you ever avoided opening your retirement statements because you were afraid of what you'd see? A lot of people have. Not because they're careless, because numbers can feel heavy when you don't know what they mean. And that's why the house versus stocks debate becomes so emotionally charged. It's really not about the assets. It's about what those assets say about you. Am I safe? Am I smart? Did I do enough? Did I mess this up? But here's what you need to know. Numbers matter, but how you feel about those numbers, that matters just as much. And nothing quietly erodes confidence faster than using the wrong measuring stick. That reminds me of that old Social Security calculator story. There was a reason people got themselves tangled up in those simple tools. They would plug in a few numbers, get one clean answer, and then treat that answer like a command from above. That's part of why those tools changed, and in some cases were pulled back or redesigned. People used them incorrectly. They used them as decision makers instead of helpers. A calculator can estimate. It cannot understand your marriage, your health, your house, your fear of market losses, or your need for sleep. Quick check. Do you know your full retirement age for Social Security? Most people don't. And if you don't, that's okay. You do not need perfection to have a successful retirement. You need clarity. Now let's talk about your spouse for a minute, because this is where a lot of plans look solid until life changes. Think of retirement income like a tandem bicycle. When both riders are on it, the bike moves one way, balanced, familiar. But if one rider is suddenly gone, the balance changes fast. In marriage, that can happen with Social Security too. Usually one benefit disappears, and the surviving spouse keeps the larger one. Some pensions shrink as well, depending on the option you chose. Meanwhile, many bills stay put. Housing, utilities, taxes, maintenance. Grief does not cancel the property tax bill. So if you're deciding whether to pay off the house, keep a mortgage, invest more in stocks, or claim Social Security earlier or later, this is not just your story. It's also the story of the person who may one day be left carrying it alone. Here's a question for the married folks. Have you and your spouse ever actually talked about what happens if one of you is gone? That conversation matters, maybe more than people want to admit. Because for some couples, a paid-off house gives the surviving spouse emotional and financial breathing room. For others, keeping more money liquid in investments makes more sense because they need flexibility. There is no one-size-fits-all answer here. That's the truth. The early retirement expert who tells you houses are always better than stocks is oversimplifying. The one who tells you stocks always beat houses is also oversimplifying. Real life is messier, but it's also more personal, which means the right answer can still be clear once you look at your actual situation. Stop measuring yourself against everyone else. Stop feeling behind and start focusing on what truly gives you freedom. For some people, freedom is a paid-off house and lower monthly needs. For some, it's a larger stock portfolio and the flexibility to move. For some, it's a mix, a smaller paid-off home, a decent investment account, future Social Security, maybe a pension, maybe some part-time income that keeps them engaged without draining them. That's what makes this so important. You are not building a spreadsheet. You are building a rhythm for your life. And rhythm matters. A big house with high upkeep can become a burden if it quietly turns you into a part-time property manager. A giant stock portfolio can still leave you anxious if every market drop feels like a threat to your identity. On the other hand, a modest house and a modest portfolio can feel incredibly rich if your bills are low, your plan is clear, and your income floor is solid. Here's something to think about. If you found out today that you're actually on track, how would that change your week? Would you breathe differently? Would you stop doom-scrolling scary retirement headlines? Would you finally believe that maybe you don't need to chase some giant number just because it looks impressive on a chart? Because the truth is not glamorous, but it is powerful. A house is best when it lowers your required monthly spending and supports the life you want. Stocks are best when they give you growth, flexibility, and a bridge to future income. Social Security is best when you claim it in a way that fits your health, your spouse, your gap years, and your peace of mind. A pension is best when you stop pretending it's ordinary and start recognizing it as one of the strongest financial foundations available today. You are not behind. In fact, you may already be standing on one of the strongest financial foundations available today. Here's what I want you to do. Start by figuring out your income floor. What money is coming in every month no matter what, now or later? Social Security, pensions, anything stable and predictable. That number matters more than you've been told. Then look at your real expenses, especially housing, not the fantasy version, the real version. Mortgage, taxes, insurance, repairs, utilities, all of it. If your house were paid off tomorrow, how much lower would your monthly need really be? Then look at the gap. What still has to be covered by savings and investments? That gap is what your stocks are there to carry, not your whole life, just the gap. After that, ask a harder question. Is your house serving your retirement, or is your retirement serving your house? If the answer makes you uncomfortable, good. That means you found something important. Maybe the house is perfect. Maybe it needs to be smaller. Maybe it needs to become part of the plan in a more intentional way. Then build a buffer, not a target number. Don't aim for just enough. Aim for enough plus breathing room, because early retirement has a long runway, and surprises are part of the deal. And if you're married, run the survivor version of your plan, not the best case version. The survivor version. Which income stays? Which one goes away? Would the home still feel manageable? Would the investment still feel adequate? That one exercise alone can change everything. Let that sink in. Because once you see retirement through the lens of income, costs, and certainty, the old house versus stocks argument starts to look small. Too small. Too shallow for a decision this important. You don't need perfection to have a successful retirement. You need clarity. If the system only rewards you with almost enough, you will spend your entire life chasing more. But if you understand your numbers, if you understand what your house is really doing for you, if you understand what your stocks are really there for, you stop chasing, you start choosing. And that is the shift that matters, from noise to clarity, from comparison to confidence, from fear to freedom. Before you go, if this helped you see your retirement differently, subscribe. There's more where this came from.